3 penny stocks to watch this week. In today's video, I'm bringing you not one, not two, but 3 penny stocks trading under $1 that are absolutely flying under the radar right now. And each one has massive potential for completely different reasons. We're talking about a green hydrogen play trading at just 3 cents that could ride the wave of a multi-$100 billion energy revolution. A veterinary health company at under 10 cents that just posted record revenue growth for the 19th straight quarter. And a real estate development stock at 3 cents that is leveraging blockchain technology for what could be a $650 million resort project. These are the kind of opportunities that most investors completely miss because they refocused on the big name stocks. But if you know where to look, this is where life-changing gains can happen. But before we dive into these 3 stocks, if you're finding value in these penny stock breakdowns every single week, do me a huge favor right now and smash that like button. It literally takes 1 second, but it makes a massive difference for the channel and helps me bring you more content exactly like this. And if you're new here, make sure to hit that subscribe button and turn on notifications so you never miss when I uncover these hidden gem opportunities that could potentially explode. Quick disclaimer as always, I am not a financial advisor and nothing in this video is financial advice. These are extremely risky penny stocks and you need to do your own research and make your own investment decisions. Alright, let's jump straight into it. The first stock on my radar this week is Sun Hydrogen, ticker symbol HYSR, trading on the OTC, markets at around 3 cents per share, with a market cap of approximately $170 million. Now, you're probably asking yourself, what the heck is Sun Hydrogen and why should I care about a 3-cent stock? Well, this is a development stage company that's working on breakthrough technology to produce renewable hydrogen using nothing but sunlight and water. Their flagship product is called the Sun Hydrogen Panel, which is essentially a solar-powered nanoparticle system that mimics photosynthesis to separate hydrogen from water molecules. If you think about it, they're trying to replicate what plants do naturally, but for industrial-scale hydrogen production. And this is what they call green hydrogen, which means hydrogen produced without any carbon emissions whatsoever. The company was originally founded back in 2009 and rebranded to Sun Hydrogen in 2020. And they're headquartered in Iowa. Now here's why the timing on this could be absolutely critical. The global green hydrogen market is projected to explode over the next decade. We're talking about a market that could grow from around $150 billion today to over $600 to $700 billion by the mid-2030s. That's a compound annual growth rate in the double digits. And this isn't just hype, this is policy-driven demand. The European Union has committed over 400 billion euros to their hydrogen strategy. The United States has allocated billions through recent infrastructure legislation specifically for clean hydrogen projects, and countries like Japan, South Korea, and China are all racing to become hydrogen superpowers. The International Energy Agency has stated that achieving global net zero emissions by 2050 will require hydrogen demand to increase more than 6-fold from current levels. In terms of recent developments, Sun Hydrogen announced advancements in their nanoparticle hydrogen production technology through their partnership with German engineering firm CTF Solar back in November. They showcased their renewable hydrogen technology at the World Hydrogen Technology Expo in Hamburg, which is one of the premier global events for the hydrogen industry, and the fact that they're getting this kind of exposure at major conferences suggests they're being taken seriously by potential partners and customers. Now let's talk about what the numbers look like, because this is where you need to understand what you're getting into. Sun Hydrogen is pre-revenue, meaning they brought in only about $1,300 in trailing 12 months. So for all practical purposes, they are not generating meaningful revenue yet. They're still in the research and development phase, which means they reported a net loss of approximately $8.2 million over the past year. However, that's actually an improvement from previous years. And their rate of loss reduction has been running at about 31.6% per year, which suggests they're managing their cash burn more efficiently. The company has minimal debt, which is actually a positive, and based on their current burn rate and estimated cash reserves, they likely have a runway of about 2 to 3 years before needing to raise additional capital. According to algorithmic forecasting models, the average price target over the next 12 months is around 6.3 cents, which would represent roughly a 100% gain from current levels, but their longer-term projections get even more aggressive with some bullish scenarios having the stock north of 20 cents by 2030, which would be over a 500% return from today's price. The second stock I want to talk about is Zomedica, ticker symbol ZOM on the NYSE American, currently trading at around 9.7 cents per share with a market cap of about $125 million. Zomedica is a veterinary health company that focuses on developing and commercializing point-of-care diagnostic and therapeutic products for companion animals, which means dogs, cats, and horses. Their flagship product is the Truforma platform, which is a point-of-care diagnostic system that allows veterinarians to run complex tests right in their clinic without having to send samples to an external lab. They also offer products like VetGuardian, which is a touchless vital signs monitoring system, and PulseVet, which is an electrohydraulic shockwave therapy platform for treating pain and inflammation in animals. What makes Zomedica interesting right now is that they just posted record quarterly revenue and have achieved year-over-year revenue growth for 19 straight quarters. Let me repeat that: 19 consecutive quarters of year-over-year growth, which is absolutely incredible for a penny stock company. In their most recent quarter, they reported revenue growth of approximately 14% compared to the same period last year, bringing in around $6.3 million with a gross margin of 66%, which shows they're not just growing revenue, but they're growing it profitably. The veterinary diagnostics market is actually a massive opportunity that most people don't think about. Pet ownership has been surging, especially post-pandemic, and pet owners are increasingly willing to spend money on advanced healthcare for their animals. The global veterinary diagnostics market is expected to reach over $5 billion by 2030, and Zomedica is positioning itself to capture a meaningful share of that market. In terms of recent news, Zomedica just launched 2 new quantitative assays on their Truforma platform for canine heart health and reproductive health. They announced a license and supply agreement with Cresilon to market hemostatic gel products in the animal health market, and they recently received CE certification for their VetGuardian system, which opens up the European market for them. On the financial side, Zomedica reported total revenue of approximately $27.3 million in 2024, which was an 8% increase from the previous year's $25.2 million. They are currently unprofitable with a net loss of about $47 million, but what's important here is the trajectory. Their revenue is growing consistently, their gross margins are strong at 66%, and they have about $91 million in cash and liquidity, which gives them a very solid runway to continue executing on their growth strategy without needing to raise capital in the near term. Analyst price targets for Zomedica range from 25 cents to 26 cents, which would represent roughly a 150 to 170% gain from current levels. The company is debt-free, which eliminates a major risk factor. And with their consistent revenue growth and expanding product portfolio, this is one of the more fundamentally solid penny stocks you'll find under $1. The third and final stock I want to cover is Webstar Technology Group, ticker symbol WBSR on the OTC markets, trading at around 3 cents per share with a market cap of approximately $12 million. Now, Webstar has gone through some interesting transformations. They started as a software company but have now pivoted into specialty real estate development with a focus on projects that can be upgraded to green energy efficient status. The big story here is their Bear Village project, which is an anticipated $650 million family resort development, and they're planning to leverage blockchain tokenization to fund and structure their real estate investments, which is a pretty innovative approach. In terms of recent developments, Webstar announced that their subsidiary, Forge Atlanta Asset Management, signed a letter of intent for a major Atlanta area development project, and they've entered into an agreement to purchase 10 acres of land for $33 million, with the closing expected in January 2026. The company is also working on cryptocurrency funding agreements and submitted a $10 million Regulation A offering at $7 per share, which if successful would represent a massive premium to the current 3-cent trading price. Now, I need to be very clear here about the risks. Webstar is essentially a pre-revenue real estate development company, which means they don't have meaningful operating revenue yet and are entirely dependent on raising capital and successfully executing on these large development projects. The $33 million land purchase is contingent on them securing financing, and if they can't close that deal, it could significantly impact the stock. However, if they do successfully close on this land deal and move forward with their development plans, and if their blockchain tokenization strategy attracts investor interest, this 3-cent stock could see substantial appreciation. The company has been restructuring, bringing in new management, and removing prior debts from the balance sheet, which suggests They're trying to set themselves up for a fresh start. The market cap of only $12 million means this is an extremely speculative play, but it also means there's asymmetric upside if even one of their projects comes to fruition. So guys, those are my 3 penny stocks to watch this week. Sun Hydrogen at 3 cents, positioned in the exploding green hydrogen market. Zamadika at under 10 cents with 19 straight quarters of revenue growth in the veterinary diagnostic space, and Webstar Technology at 3 cents with ambitious real estate development plans leveraging blockchain. Each one of these represents a completely different sector and risk profile, which is actually great for diversification if you're building a penny stock watch list. But I cannot stress this enough. These are extremely high-risk investments. Do not put money into these that you cannot afford to lose completely. Always do your own due diligence. Read the SEC filings, understand the business models, and make informed decisions based on your own research and risk tolerance. What do you think about these 3 stocks? Are any of them on your radar? Drop your thoughts in the comments below because I love hearing different perspectives and seeing what you guys are watching. If you found this breakdown valuable, make sure to smash that like button, subscribe to the channel if you haven't already, and let me know what other penny stocks you want me to analyze next week. I'll see you in the next video.